Hello and welcome to a brand new show of Market Makers. Markets surely this year have been hit because of the OCD syndrome. Oil, China and debt. But thankfully for us globally, the economic news is not that bad, and most of the central banks have assured that they are back and they are committed to follow a highly accommodative monetary policy. The short crude trade seems to be reversing. The long dollar trade also seems to be reversing. So what is the way forward for Indian markets now? And especially given the importance of union budget, is it time to start aligning portfolios in anticipation of a good and a grand mega budget? So to discuss margin of safety, sector themes and the global connect, I have with me Navneet Munot, CIO with SBI Mutual Funds. Navneet, fantastic to have you back and thank you for joining us. It's been a very tough start. It's been a very tough year. Now we can talk about China, some may argue about oil, some may argue about debt, but it's a perfect storm right now.
So as FDR said, Franklin Roosevelt said, we have to fear the fear itself. So there is fear in the equity market. The global equity markets are down. Global bond markets, yields have inched up substantially. We have seen the real carnage in the commodities market with Commodity Research Bureau, Reuters Index at a multi-year low, and what we are seeing in the currency markets. But my sense is that historically, whenever you have seen the global equity market falling 10%, barring I think one instance in 1987, 88, most of the time it coincided with a global recession. And my sense is that I don't think that a global recession is coming. I don't think that the global economy actually is deteriorating. I think the momentum is actually improving. There is a 1% risk. There is a left tail risk, which is a risk where the possibility of that happening is very small, but the consequences could be very large. Let's say something happens in China, the outflows, they are not able to stem and they have to devalue substantially. But I think the possibility of those events happening like 2008 is very small, and my sense is that the global economy actually is improving. When I look at the payrolls data in US, in Europe, in Japan, unemployment is at a multi-year low. Yeah. When I look at Euro PMI, it's at 53.5, it's improving. Global consumers have improved their balance sheet. The real effect of lower commodity prices improving the consumer spending, we haven't seen that yet. And maybe we can discuss more in detail about China and commodities. But I think there is some disconnect between what the markets are telling us and what the underlying economy is telling us. But sometimes, if you believe in that theory of reflexivity, which Soros taught us, George Soros, that sometimes the markets may actually change fundamentals. I hope it doesn't happen. But markets maybe, some of the markets may be down because of the valuation, but I think overall macro is not that bad as the markets are telling us.
Soros is also saying that this could be a repeat of 2008. So you follow Soros. Would you like to follow him on this case?
Not. The more I look at the global economy, I don't get a sense that we are in 2008. As I mentioned to you, I think the global consumers, their balance sheet has improved. Most of the places, I think they are in a better shape. So there were three phases of this whole commodity prices fall. The first was the 2014-15, where everybody thought it's great for the world. A soft landing in China, commodity prices falling, money shifting from producers to consumers, a lot of macro balance sheets improving like India was a great news. This is the second part of that movie, where we are seeing a capitulation in commodities market. Now, which is leading to all the earnings collapse in S&P and some of the other indices because of the energy commodity companies, commodity producing countries, they are seeing a real meltdown in their currencies, equities, bonds. You are seeing sovereign wealth funds selling. You are seeing a geopolitical risk because of the commodity prices falling. And all these things are impacting the market. This is a time where we have seen the oil having a correlation of almost 1 with all the financial markets. I think this is the capitulation. The third picture abhi baki hai mere dost, and that's the code. The third part of it, when commodity prices stabilize slightly higher than these levels, where the money shifts from the producers to the 7 billion global consumers, it's going to be good for the world. We were spending $100, sending it to Saudi Arabia, and Saudi Arabia sovereign wealth fund was investing, let's say, in our equities or various other risk assets. Was it good for the world? Or it's good that we pay whatever $40 or $35 wherever it settles, and then we invest that money somewhere else. I think that's good for the world. So the third part of that transformation in the commodities market, the turn of tables, I think is going to be a good news for the world. We just have to ensure that it doesn't lead to a big systemic crisis where there's a large blow up in one commodity producer and which impacts the banking sector, which happened in 2008. I see a less possibility of that happening this time.
If I look at the oil producing countries, whether it is Nigeria or Saudi Arabia or Qatar, they are feeling the heat now. Nigeria has made it official that they will protect the forex reserve now. You cannot import from motorbikes to toothpaste into Nigeria. The effect of that would be visible. We know what's happened to US junk bonds now. The spreads are at a record high. So maybe right now there is no problem, but given the destruction in commodity market, a problem could come out. You know, when the subprime problem was discovered in May 2007, everybody ignored it. 2008 it hit us. So when such a large disruption is happening, why should we undermine the effect?
No, absolutely. As I said, there is a left tail risk. And if that's your base case, then of course you are right. My base case is not that. I think commodity prices are showing signs of capitulation. Okay. And it's not only about energy, industrial metals. I think most of the other even soft commodities. My base case is I think most of the commodities are hitting a bottom. And probably as we see better signs of global recovery and some of these commodity prices recover and things change very dramatically. One of the best part of this commodity meltdown is that this is entirely supply side driven. This is not a demand destruction in the world. China is importing more copper this year than what they imported last year. The oil consumption in the world is higher, not lower. I mean, Japan started nuclear reactors, LNG supplies have come, shale revolution in solar and wind, Iran coming back to the market, Saudi Arabia pumping more, Russia pumping more. It's a supply side response, good for the world, it's not bad. But I completely agree with you. If there is one blow up in, let's say, something happens geopolitically somewhere in Middle East, of course it can have massive repercussion, maybe bigger than 2008, but I don't think that should be a base case for anybody. The third part of that movie, turn of tables in the commodities market, where actually prices stabilizes at a certain level, and the shift of money that happens from the consumers, from the producers.
How far
to the
are we away
consumers.
from it?
I don't think it's too far, and there are right signs. Even for the China, which is at the epicenter of the entire problem, because even commodities to a large extent are linked to that. I think they're taking the right steps. I don't think this time they're trying to do, the world's longest bullet train project or something, because they know that there has to be a soft landing. They've moved from $2 trillion to $10 trillion in a short period. I think over a period of time, the gradual shift from the manufacturing and the export-led economy to a consumption and services-led economy. Last year, 7 out of the top 10 movies in the world were produced in China. They were the Chinese movies. So there is a service sector which is growing. But of course, that part of the manufacturing, they are 1/4 of global manufacturing. They are 1/4 of global trade. So the world that transition is painful, but I think they are making the right transition. And remember, there are over 1 billion people with $7,000 per capita income. It's going to be a large growth driver for the world even going forward. And I think if that transition is smooth, so they've done a phenomenal job in last 30 years on the manufacturing side, what they've done. I think they don't understand as much the financial markets, whether the monetary policy, how to manage currency, how to manage equities, how to manage bond, all those things. But over a period of time,
sometimes they're putting a circuit limit, sometimes they're taking out the circuit limit, and the worst thing they've done is to prop up the market by local money. Okay, so my next question is that do you think we should not look at the Chinese stock market as the real barometer for Chinese economy? Because when the way Chinese stock markets have come down, we tend to indicate or we tend to judge that Chinese stock market is telling you what is happening in China, but we should not confuse.
Never. And you go back in history and see last 25 years, whether the Chinese equity market was a good indicator of what was happening in the real economy, there has always been a disconnect. So I don't think people should look at the Chinese market and then draw a conclusion of what's happening there. There is a big debt overhangs. Their debt to GDP went up from 100% to 300%. When a country moves like that, you have 3 options. Either you stagnate, or you default, or you inflate. Highly unlikely they will default or inflate, but there will be a stagnation a little bit. But I think the bigger transition that the world should keep in mind is that if that's such a large economy, a $10 trillion economy, moves from a manufacturing-led to a services-led, it cannot be bad for the world.
It is often said that markets, they tend to move forward. And right now, the news or the bad news what we talk about is all yesterday's data, whether it is China, collapse in commodity, or the fact that there is a lot of debt at government level. So why are markets reacting to this data in 2016? And are markets telling us a signal that more bad news is coming?
So globally, various reasons. It's not only about the data today, but also maybe some of the markets ran ahead of the fundamentals.
Okay.
Look at the US S&P. I think the profit margins are close to all-time high. They've fallen a little bit in last few quarters, but over the last 10 or 15 years is the highest point. So maybe valuations were running slightly ahead of the fundamentals, and now people are realizing that corporate profits cannot grow at the pace that they've grown for several years. So some bit of correction had to happen. Even that easy money, that phase, I mean, that's another transformation which is happening in the world, where maybe some of the central banks are going to print more money, but when Fed indicated that we are going to tighten, we have to move away from that central bank put option that has been given across all markets, and you've got a sign that that put option is not available. So I think those transformations are big in nature. They impact markets, which we are witnessing today, but some of it over a period of time, I think
So right now markets are wrong. I mean, the collective wisdom is telling us that the market movement is telling us that something dire is coming. But like Howard Marks, wrote in his latest memo that we should not look at the market movement as the real indicator of what is coming next.
That's precisely I said that. I think there is a disconnect between what the market, the panic that you see in the market and what the underlying economy is telling you. Maybe some bit of this correction was required because of the valuation, but it's not a forward looking indication that yes, the global economy is going into recession.
It's emotional
My base
sell-off.
case is not a recession.
It's an emotional sell-off. It's a sentimental sell-off. Fundamentals are not that bad and the selling is overdone.
But I think if you dissect, so let's say if you look at, for example, US, the biotech index is down 20%, there were issues, they had to fall. But bulk of the pain that we are seeing in the world is led by the commodities. And because of those currencies, even the S&P, or if you look at Europe, the commodity companies, even in the bond market is the commodity companies. But then you look at the lenders, so the banking is in trouble because the commodity producers, they have the exposure. So it's becoming a self-reinforcing, where the problem in one market is impacting the other market, and that becomes a self-fulfilling
The bottom line is the selling is overdone.
I think we are getting to that stage where it's overdone. My sense is that I think after this holiday season, I think China will take some more steps to stabilize the economy. And if the outflows don't become unmanageable, they still have, remember, close to $300 billion of current account surplus this year. I think if the outflows don't increase substantially, if they are able to manage the gradual depreciation in the currency, and if the economy stabilizes even at, let's say, 5% growth, whatever is the official number, the world should be okay. And my base case is that I think commodity prices are bottomed, and I think we are going to see a slight uptick, not only in crude oil, but across all commodities.
On paper, I can prove that India has the best macro, but that great macro has not translated into great micro. So our market's telling us that, look, great macro is not necessarily a guarantee for great numbers or great earnings recovery.
So by the way, historically 2003 to for several years, we were actually quite positively correlated with the crude oil, Nifty and crude oil. We saw a disconnect between 2014 and 15, where first time we thought that a falling crude oil price is good for our macro, because macro was a big challenge in 2013. At the beginning of 2015, coming back on a big rally in 2014, the expectation was that improved macro will translate into a better micro, which is the corporate profitability. That didn't happen. And some of the pain that we took in terms of fiscal consolidation, in terms of a focus from a monetary policy on inflation, is also impacting the corporate profitability negatively. So what improved the macro is also impacting very negatively. So let's say if you are spending less money, less MSP hike, less subsidies, the rural economy is in a distress, and also on the back of two successive bad monsoon. If the nominal GDP is growing at 7.5% and the corporate is paying interest at 10 and 11%, how will the deleveraging process will happen? My revenues, my asset values are growing at 7%. And I'm paying 10%. So there is some pain that we are seeing of the macro correction that we have seen. But I think over a period of time, I think the base that will get created in December and March with whatever we have in the banking system and other corporates, on that base, I think we move to a normalized earnings growth next year.
What is your understanding of the banking sector? You think markets are overestimating the NPA pain?
So maybe markets underestimated the NPA pain earlier, and that's why for a long time, we have discussed it earlier, we avoided most of the lenders that had exposure to these stressed names, and we were better off with the lenders in the retail market. There are two parts in the banking. One is the cyclical issue, which is the NPA, and which is, let's say, the low credit growth of 8%. And there is a more structural issue that I'll discuss separately. So I think this this cleanup that's happening at this point in time, of course, in 2 quarters, if it has to happen, I think it's going to be very, very painful for the system, because the way problems have been, even in the real economy, some of these sectors are in distress. So let's say we have to do a lot more for the steel sector. If it has not been done, I think it's going to be painful. But after this cleanup is done, I think the sector will come out much more stronger compared to where it is today. And of course, some of the other announcements that have been made by the government in terms of governance have to be done. There is a more structural aspect where the digitization, where the disintermediation, where the differential regulation will change the face of financial services over a longer period. But that's a different story. We'll keep it for later. So maybe the markets, I think the valuations are not only telling you that there is a big cyclical issue today, but there is some structural thing which the wisdom of the market not talked about because you are too focused on that, but it's also telling you that structurally margins are going to be under pressure with the kind of digitalization, the new players coming into the market happening, and the disintermediation is another strong
So it's
force.
hard to make big outperforming returns in the banking sector now. Is that what
from a tactical basis? Of course, I mean we own relatively more safer names, but from a tactical basis, I think some of the names are corrected quite a bit, and I think that it could be a good trade for next couple of quarters.
So, what is looking interesting and good in this market? IT companies, there is a growth challenge. Pharma company, US FDA is disruptive. For industrials, the private sector capex has not picked up. For banks, it's NPA issue or credit growth is flat. Consumers are expensive.
Yeah.
What does one do in this market then?
So I have a theory that I think while the global is not only in India, we are focused on China and commodities and some of these things. There are lots of other disruptions that are happening. So we read once in a while over the weekend and we think, yeah, I mean, there is something happening in transportation industry, something happening in energy, something happening in some of the other sectors, the way technology is changing things. But I think it's also reflecting somewhere, I think I've seen this in 90s, where when we opened up in 91 and we thought that everybody in India are going to do so well because India will become such a big liberalized, globalized economy. But large number of sectors, large number of companies went through tremendous amount of pain in 90s. I think don't think is going to be different. When the way of doing business changes, when the ease of doing business is done, when you put new technology, when the logistics is improving the way it is, and you put substantial fall in the input cost, all put together will give birth to several different kinds of new businesses, new managements who are small.
So as an investor, where are you picking your spots?
So there are several. So whether in the consumer space, I think there are lots of new guys, I think, who will really scale up. I think India, as we go from $1,500 to $3,000, $4,000, $5,000 per capita, I think bottom of the pyramid, premiumization, new categories emerging, I think is
So you like niche FMCG or niche consumer?
Niche consumer place. Even in the infrastructure, the pain is there maybe for another a year. But I have a strong view, India will have an investment super cycle. I don't know whether it begins in 16 or 17 or 18, but we'll have, look at the urban transportation. I think whether in the transmission distribution of power, in terms of defense, in terms of railways, roads, I think will multiply, waterways. Most of this infrastructure, it's only a matter of time. One cannot say it's not going to happen. It's going to happen. It's only what's the beginning point and what's the tipping point. We have seen some bit in roads. I'm sure next year a lot of hard work being done in last 1 year.
The numbers are not showing. I looked at the numbers.
It's not showing. I completely agree with you. But I think if you are with those companies that have operating leverage, that have the ability to participate in that, as and when that happens, I think we are better off. What you need to be aware of, who can survive till that time. So avoid financial leverage till that time. But I think somebody has the capacity, and it's not only in India. I think globally, I think that the monetary policy has run its course, and increasingly governments will realize world over that the fiscal policy has to take the lead. And I think infrastructure build-up is something now where the commodity prices are and where the borrowing rates are. You have a 5-year German bond at negative yield. You have a 10-year Japanese bond close to zero now. I think those governments at some point in time will realize that I think we should invest in infrastructure, and I think there will be lots of opportunities in India.
So when you say infrastructure, is it roads, it is railways, it is transmission, is it power, urban infra? Where are you picking your spots?
Yeah, so there are individual places where again I repeat the same word, those who have capacity, those who have the execution ability, those who have the balance sheet which is intact, those who have the vision that as and when that opportunity arises, how to make the best of it. And particularly those, again I'll repeat the same point, those who have kept their balance sheet intact. In the next cycle, when the large orders come, some of the people won't even get the bank guarantee, and the competition is going to be less. As an equity investor, as a bank's lending investor, all will ask for a better returns, all will ask for better cash flows. We won't give money because we are building order book. It's going to be very different next time.
Of course. One highlight of 2015 has been the way domestic investors have made a comeback. Finally, they're endorsing equity as an asset class. Alternates are doing very poorly. Gold has not given great returns. Fixed deposits, we know where returns are. They made a comeback, and the investment number for 2015 was $15 billion, highest we've seen in a long time. Is that trend here to stay? And given market volatility, what has been the trend there?
So I think it has happened in some of the other countries earlier. I think it happened in Korea a few years back, where foreigners were selling and the domestic investors were buying, and ultimately they were proved right. I think in India, because of the global challenges, because the sovereign wealth funds are selling, because there is redemption from emerging market equity fund. So India is like, as somebody said, nice house in a bad street. Because of that, because everybody is selling that bad street, we are also getting sold, and it's good for the domestic investors. But for this, markets wouldn't have been where we are today. And of course, this NPA angle probably has depressed sentiment a little more. But I think once we stabilize, for domestic investors taking a 3-5 year view, he'll make good money.
So what's the picture this year? Outflows haven't started. It is still inflows at the industry level.
I think we have a long way to go. I think the people who have invested in equity so far are the people who are, the so-called smart investors who understand equity, who understand mutual fund. We haven't really seen it becoming a revolution where the retail participation increases in a substantial manner. We are yet to see that. There are already more than 8 million SIPs, so roughly somewhere between 2.5 to 3,000 crore is coming from the SIPs alone. At some point in time, and as the EPFO is investing now, the other pension funds are investing, over a period of time, I'm sure that domestic institutions will become sizable to counterbalance what the FIIs can do.
So broadly, if you have to summarize today's interaction, you're of the view that don't look at local factors. Global factors, they hold the key, and globally you think the selling is overdone. If not a bottom, we are nearing a bottom.
I think so. As you named Howard Marks, I don't know, I think a couple of years back, he said this: when the knife stops falling, when there is absolute clarity on the horizon, when dust settles, you can be rest assured there won't be any bargain left. This time won't be any different.
And right now, certainly the dust hasn't settled. Everyone think, the general.
But then there won't be bargains left.
Course, like I always say on air, good news and good prices, they rarely come together. Right now, the news is bad, but prices are good. Okay, really appreciate your time. Glad you could join us. And that's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for tuning in. Thank you for watching the show.